In this video, I'll show you how to trade with margin on Bybit, including a live example of opening a position, borrowing some assets to trade with, and then exactly how to repay your borrowings as well. I'll leave timestamps for all of the different sections down in the description below. If you're a new user to Bybit, the link down there gets you an extra bonus as well. If you click that, go through and sign up. When you make a deposit on the platform, they'll give you a big deposit bonus to trade with via that link. In order to get to the margin trading screen in Bybit, we actually go to the spot trading screen. That's where we're trading. We're just doing so with margin from the exchange, which I'll explain. So go to trade, spot, then choose the currency pair that you want to trade. Up in the top left, you can choose them. And on the right-hand side, you can see these multipliers. That's the maximum amount of leverage that you can take with your trade. So if you had $1,000 down, you can open up a trade size worth $10,000. You don't have to use that much leverage at all, but that's the maximum amount. Now, once you've chosen the currency pair that you want to trade, go to the top right-hand corner, this right here, you want to click this on, and now we can use margin with our trades. What exactly are margin and leverage then? Margin is the amount of cash or value that you have down in order to take a trade. So that's your margin. Now, leverage is the trade size in comparison to how much cash you have down. So let's say you have $1,000 down or 1,000 USDT. Now on Bybit, which I'll show you in a second, there's a unified trading account, and we can use multi-asset collateral to fund our trades, which means we can use USDT, USDC, Bitcoin, ETH, and a bunch of others all together. And the dollar value of those can be used as our margin, as our cash down. Leverage, like I said, trade size in relation to how much cash you have down. So if I've got $1,000 of cash, or Bitcoin or whatever else, and I take 3x leverage, that means I can open up a trade size worth $3,000. That's 3x leverage. So what I can do if I have $1,000 cash is actually take a position that is 3x larger than my cash. And the reason they let us do that is because we have this $1,000 of cash to collateralize our position, meaning basically if we make a loss, we've got $1,000 there to pay for a $1,000 loss in our position. If the loss in our position is greater than the amount of cash that we have, that's when we get liquidated. The exchange will say, look, you've got no money to pay the loss, so we're going to get out of the position, sell your collateral, we're going to fund the trade and the loss there and get you out. So that is using your collateral to basically have a larger size trade. However, the other way to do it is simply to put less down on the exchange. So you still have the same $1,000 trade, only this time you're funding 33.3% of it, right? 1/3. So you can fund less of the trade and still trade with your same size. That means that you have, another $666 out of the exchange or somewhere else, or earning yield or doing anything else, or opening up other positions or anything that you want. So you don't have to take a bigger position size than the cash that you have. You can actually just put less down and open the same position size if you want, and then use the cash elsewhere to do something else. With leverage though, each percentage move in the price is then exaggerated by the amount of the leverage. So if we're using 3x leverage, a 1% move in the price is like a 3% move in your underlying collateral, right? So a 10% move with no leverage and $1,000, that's a 100% move, either down or up. But if you're using 3x leverage, that would be like a $300 move, because now you've got a bigger position size, which is 30% of your underlying cash. So the main thing to worry about really is making losses and being able to fund a certain amount of volatility in the price. If we think the price can fall a certain amount, let's say 20 or 30%, we need to make sure that we have the cash there to fund that downside volatility rather than getting liquidated. So that's the main thing when using leverage, is making sure we have enough cash to pay for our positions and the downside volatility. Bybit use what they call a unified trading account, and this is where we put our assets to go ahead and trade. Now, when using margin or when trading in the futures market, what we're doing is putting less cash down and then opening a bigger position size than the cash that we have. And so we have to tell Bybit exactly how we want that to happen. So go to the top right-hand corner, click the settings icon here, and then margin mode. You want to click this on the right-hand side, and then you can choose. Isolated means you can take one position with a certain amount of collateral and that's it. So if you're trading Bitcoin USDT, you might have USDT as collateral there. That's collateralizing that trade. If you open up another trade with a different asset, so let's say we have two trades. One is Bitcoin USDT, one is ETH USDT. That collateral will be isolated between the two positions, and they'll be completely separate. Now with cross margin, all of your positions are margined at the same time. So you may have a Bitcoin trade and an Ethereum trade, and you've got some USDT in your account. That USDT is being used to margin both of those positions at once. And that means that you might have a loss in one that can bring down your other position, rather than the isolated margin, which is, let's say you have a loss in one position, that position loses and gets liquidated, the other position will be fine. Now with cross margin as well, you can use multi-asset collateral, as you can see here. That means that we can open a Bitcoin USDT trade, and in our unified trading account, we might have some USDT, but we may also have some ETH and some Bitcoin and some other assets. And if we use those as collateral, then the dollar value of those is used to collateralize our position and margin our positions. So this means that we're opening our entire account up to margin everything at the same time. Now, you can use profits in some positions to actually take more positions. So if you have equity in your account and the dollar value of your account is higher because you're making trading profits, that can actually be used to open further positions. And of course, with multi-asset collateral here, that means the dollar value of our collateral is going to change every single second because the dollar exchange rate of all of these assets will change. So if you put Bitcoin in to collateralize your position, let's say you've got $1,000 of Bitcoin. Well, let's say the Bitcoin price falls 10%. Well, your collateral value will fall 10% because the USD value now is only $900. So it opens you up to more volatility, but obviously a much wider array of trading positions that you can take as well. So it's up to you which one that you want to choose. If you're just beginning, maybe try isolated. As you progress, you'll want to go to cross margin because it just makes things a lot easier and gives you pretty much all the options. However, if you have open positions, you cannot cross between them. So you'll have to close your positions first with one of them if you want to change which type of margin mode that you use. I'll show you my unified trading account so you can get an idea of how to use assets as collateral. Go to your assets here, then you can go to unified trading. You can see I'm using cross margin, and I'll tell you that I've got $100 of USDT and around $100 of ETH. Both of these are being used as collateral. You can see on the right hand side, these are toggled on. You can toggle on and off this. So for example, if you don't want to use Bitcoin as collateral and you've got it in your trading account, just toggle it off. Otherwise, any assets that are toggled on will be used to fund your positions. And if you make trading losses, they may be liquidated in the future. So toggle off any assets that you don't want to use here. And also you can just transfer them out on the right hand side, press transfer, send it into your funding account, and then it won't be used for trading at all. So I've got around $200 worth of collateral that I can use to open positions. You can see on the right hand side, I'll toggle off margin here, and you can see that the biggest position size that I can take is the amount of my USDT, which is around $100. You can see here. Now, if I toggle on margin and I'm going to use 2x, that means that I should be able to open a $200 position because I've got $100 of USDT. You'll see that actually it's closer to $300. This is because I've got some ETH in my account, and the dollar value of that is being used to fund positions as well. There is a small impairment charge in terms of the value of the ETH versus how much you can use, because ETH is a completely separate asset to the pair that I'm trading. So they have to give a buffer just for the price of that, because that can be volatile outside of our trading position. So there is an amount of the ETH that I'm using here to be able to fund my trades, as you can see, because I can now open a trade size of 300, which is obviously more than 2x the $100 that I have. Now we can choose the maximum amount of leverage that we want to trade with. So that's this drop down here. 2x means 2x your collateral, 5x, 6, 7, 8, 9, right? It's up to you. But this is the maximum trade size. So what I did is transferred the ETH out of my account. So now I have $100 worth of USDT in the account, as you can see here. So that's what we can use to collateralize trades. So 2x leverage means my maximum trade size can be around about $200, as you can see here. If we choose 5x, then the maximum trade size will change. Obviously $500 now, right? $100 times 5, it's around $500 value here. This value, this is your actual trade size. So let's say we put this back to 2x, and I've got $100 in the account, and I want to open up a trade size worth $50. Notice that the amount to borrow is 0. It's not going to automatically borrow money for you if you can fund your trade outright. So 2x is the maximum amount of leverage. Let's do a $150 trade. You can now see that because I've got $100 of collateral there, I have to borrow $50 in order to open up a trade size worth $150. So this right here is just the maximum amount of leverage that you can use. However, because we're trading on margin, what we can do is open up a trade size that maybe is borrowing some money, But after our trade is open, we have two options. We can either repay the loan, because what we're doing here is borrowing USDT from Bybit, right, in order to go ahead and trade with. So we're borrowing USDT when we open this trade. We can repay it by transferring USDT into the account, and we can actually repay the loan that we're taking now and basically buy the Bitcoin in cash, or we can sell out of our position, and whatever the profit or loss is, we exchange that, and then obviously we sell out of the position and we want to pay off the loan with the USDT that we get from selling the Bitcoin later. So that's how you open positions. I'll show you a couple of examples now. Bybit has an auto borrow feature. So whatever your trade value is, they will borrow the amount necessary. So we're going to open a long here, just a market order to get it open, $150. That means we have to auto borrow $50 right here. So we can go long like this. You can see that we're margin and the 2x trade size quantity is this. Order value is 150. We have to borrow $50. You can see the daily interest rate as well. There is a daily interest rate because we're borrowing $50 of USDT. So once that borrow is open, we will be paying interest on it. And we have to pay for that interest as well with USDT. It's a USDT loan that we have to pay for. So you need to make sure that you're managing your loan and your interest. Interest rates can change as well. If loan demand is very high during bull markets, you may have to pay slightly higher amounts. In bear markets, borrow rates may be cheaper, but that is a variable interest rate that we have to keep an eye on as well. So let's go long and we can open that position. And you should see that I now have a borrowing. I am now borrowing 50 USDT from the exchange. That is a liability that I have in my account, and I'm either going to have to repay that right here by transferring in some USDT, or I can sell out of my position because I now have a Bitcoin balance. So I now have a trade open and I have Bitcoin in my account, which has a value. And so if I need the USDT to pay off this loan, I can of course sell the Bitcoin that I just bought, and hopefully that's enough to pay off my loan. If I make a loss in the trading position, it may not be. So I may still have to then fund more USDT into my account to actually pay the loan. If I made a big profit in my position, then I can just take some profits out of that trade, sell Bitcoin back into USDT and pay off the loan if I need to. I'll show you in my unified trading account now what exactly it tells me. You can see that I now have a balance of Bitcoin, $150 worth. That's what we bought. But I also have a liability here, which is a minus 50 USDT. So I am now short 50 USDT in the account. Now, the reason they will let me do this is because I have a dollar value of assets in the account to fund any potential losses of $50. So I've got $150 worth of Bitcoin that I just bought, and that's more than enough to pay off this debt. So if I make losses in my trading position, I can have a pretty significant loss before I get liquidated to pay off this debt. But I do definitely have a negative balance of minus 50 here that I need to sort out at some point in the future. If we go back into the trading screen, you can go into your borrowings here, and we have a live borrowing $50 of USDT. Just above my head, as you can see here, there is a repay button. So we can go ahead and repay, and we don't have any USDT in the account. So what we're going to have to do is sell out of our Bitcoin position. That is going to sell Bitcoin back into USDT, which is going to release that USDT, and then we can pay off the loan. So we can click repay, and the repayment amount is equivalent to $50. So press confirm. So let's go ahead and do that. Done. And we don't have any borrowings anymore. We repaid that loan. Now, if we go back into the unified trading account, you'll see that I paid off the loan. So I now have a zero balance of USDT, but because we're trading in the spot market with margin, I only had a $50 loan, right? So the other $100 I actually just paid for. And so as you can see here, we now have the Bitcoin. So we repaid the loan by selling the Bitcoin, or enough Bitcoin, in order to pay off the loan. But of course, we did actually just fund and pay for an amount of our Bitcoin trade. The other way that we can pay off a USDT loan is by depositing USDT onto the platform and using that to pay off the borrowing. In that way, what we're doing is essentially paying for the position. We're buying it down. So I got out of my Bitcoin position and I have $100 of USDT back in the account. So let's go and open a long again, borrow $50, but this time actually just use USDT to pay off the position. So as you can see here in my unified trading account, I've got $100 of USDT. So what we're going to do is open a long position, That position will be $150, so we have to borrow around $50 here. So we'll go long and open that position. We now have a borrowing of 50 USDT. Last time what we did is sold enough Bitcoin back into USDT to pay off the loan. So I've got $150 of Bitcoin again, and we've got this loan. Well, what I'm going to do now is simply transfer an amount of USDT from my funding account. So I'm going to press transfer here, and I'm going to transfer from funding into unified trading. I've got around $46, so I can't pay the whole lot off, but I can pay a chunk of it. So I'm going to press confirm like this, press confirm, and you can see that it automatically pays off the borrowing. So we now have less on borrowing, only $6. So again, what I can do now is either sell some Bitcoin to pay off the loan, and then we'll have no borrowings, or I can deposit some cash, turn it into USDT, transfer that into my unified trading account, and it will automatically start paying off the loan that I have taken. In the description box below, I'll leave a bunch of videos that will be helpful on margin trading, futures trading, and for Bybit. And the Bybit deposit bonus link for new users will be down there as well. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.